Welcome in, everyone. Today is July 8th, 2026. And right now, the market is having what I can only describe as a massive identity crisis. I mean, Jeff Bezos' space company just hit a private valuation of $130 billion, while Elon Musk's SpaceX is just taking an absolute beating on the open market. And meanwhile, the people in charge of the U.S. economy, they literally can't agree if they should hit the gas or the brakes.
Yeah, it really is a profound contradiction right now.
Right.
Because the data we're looking at today, it paints a picture of a market that is simultaneously panicked about these very traditional, almost, 20th century problems, while aggressively funding 22nd century solutions.
Right. So, okay, let's unpack this, because our mission for today's deep dive is to really make sense of this daily market briefing for you and figure out how businesses are navigating this extreme macroeconomic whiplash.
And it really is whiplash.
Oh, totally. And, spoiler alert for you listening, the most successful companies right now, they're surviving by heavily investing in their own physical futures. But before we get to the corporate strategy side of things, we have to understand the weather they're operating in.
Exactly.
And right now, that macro weather is a Category 5 hurricane of uncertainty.
Yeah, we are basically looking at two massive sources of instability, right? And they're colliding at the exact same time. You've got domestic monetary policy on one hand and global geopolitical friction on the other.
Both just completely up in the air.
Deeply unsettled. And they are pulling the economy in completely opposite directions.
Yeah, so let's start with the domestic side, right? The Federal Reserve just released the minutes from its June 16th to 17th meeting. And typically the Fed, they go out of their way to present this united, calm front. They're supposed to be the steady hand on the wheel.
Right, the adults in the room.
Exactly. But these minutes, they reveal a really fundamental split among the officials on the actual direction of interest rates.
And that word direction, that is the key to the panic here. They aren't just arguing over, the magnitude of a move, like, oh, should we hike by a quarter point or a half point?
Sure.
No, they are fundamentally divided on whether to hike rates to cool down stubborn inflation or to cut them to stimulate a sputtering growth engine. They are looking at the exact same economic indicators and drawing totally diametrically opposed conclusions.
Which just sounds completely unworkable to anyone trying to run a business. It's like being in a car where you have two drivers in the front seat, right? One is slamming their foot on the gas pedal and the other's just stomping on the brake. How can the market possibly price in risk when the people steering the economy can't even agree on which direction we're going?
Well, mechanical pricing breaks down entirely when that happens. Think about how a company is valued, right?
Okay.
Institutional investors rely on discounted cash flow models, DCF, to figure out what a business is worth today based on what it's going to earn tomorrow.
Yeah.
And the interest rate is the denominator in that equation. It's the fundamental cost of capital. So if that denominator is unpredictable, like if you don't know if your borrowing costs for a new 5-year factory build will be 3% or 8%, the present value of those future cash flows swings wildly.
Wow. So the spreadsheets basically just become useless.
Pretty much.
You can't plan massive capital expenditures if the cost of the capital itself is a moving target.
Exactly. Capital freezes.
Yeah.
It seeks out extreme safe havens. It creates this baseline of anxiety across every single sector because absolutely nobody wants to be caught heavily leveraged on the wrong side of the Fed's ultimate decision.
And while the cost of money is entirely up in the air here at home, the cost of energy just took a massive, massive hit. Because the briefing highlights that oil prices just jumped over 4% in a single day.
A huge spike.
Massive. And the catalyst for this spike was comments from Donald Trump threatening to bomb Iran and reimpose a naval blockade in the region. And really quick, just as a disclaimer, we're pausing here just to be very clear to you listening. We are impartially reporting the contents of the market briefing. We're not endorsing any political viewpoints or taking sides on this at all. We are purely focusing on the market reaction to these statements.
Right, because regardless of the politics, the market math is immediate.
Exactly.
A 4% jump in crude oil is a massive immediate tax on the global supply chain. What's fascinating here is how a single geopolitical statement mechanically alters the operational reality for thousands of businesses before a single physical ship is even moved.
Right.
If you're an industry that relies heavily on oil imports, shipping, manufacturing, airlines, or even basic logistics like trekking goods from a warehouse to a retail store, your profit margins just shrank in the span of a single news cycle.
Unbelievable. So you have the Fed utterly confused about the cost of money, and you have global tensions driving up the cost of energy. Companies are just trapped in this dual threat environment where the macro level is totally unpredictable.
You cannot rely on a stable macro environment to lift your boat in 2026. You just can't. You
Yeah.
have to build a stronger boat.
Which is exactly what we are seeing happen at the ground level, right?
Yeah.
Companies are taking control of their own destinies to survive this exact whiplash. And here's where it gets really interesting. Because the survival strategies between Main Street retail and Silicon Valley tech are entirely different.
Completely divergent.
Yeah. So let's look at Levi
The
Strauss.
denim giant, yeah. They are pulling off a remarkably agile playbook right now.
They really are. They just beat their quarterly expectations. And not only that, they raised their future guidance and bumped up their dividend payout to shareholders. I mean, in this chaotic environment with interest rate confusion and oil spikes we just talked about, Levi is thriving. And the briefing attributes this to their ability to adapt to changing consumer trends and successfully expand into new markets.
Levi is a legacy brand, sure, but they are utilizing real-time data like a tech startup. When supply chains get expensive or domestic consumer spending falters because of those interest rate fears we just talked about, Levi is finding growth by reaching outward.
Interesting.
They are aggressively finding new geographies and pivoting their product lines to meet the consumer wherever they are spending right now.
So they're outrunning the storm by staying incredibly light on their feet.
Exactly.
But if we pivot from denim to the absolute top of the market, the strategy flips completely. Because tech is driving broader market growth right now. Nvidia, Apple, and Microsoft are listed as today's top gainers. And Apple, Microsoft, and Amazon are the most active stocks overall. And Apple's survival strategy, it's the polar opposite of Levi's agility.
Oh, yeah. Apple is abandoning the light on its feet approach entirely.
Right. They just committed a staggering $30 billion to Broadcom for a U.S. chip-making push. And the briefing notes this is Apple's largest American manufacturing commitment to date, specifically to support the growth of the iPhone and other key products. So Levi is expanding outward, but Apple is pulling its supply chain inward.
Apple's $30 billion move is a direct, calculated response to the geopolitical friction and supply chain fragility we just outlined. They are executing a massive deglobalization strategy.
But wait, I mean, $30 billion to Broadcom just to build chips inside the United States? That seems like a massive margin hit for Apple. Historically, the entire tech industry relied on this beautifully optimized, hyper-efficient global supply chain.
The golden era of globalization.
Right. You design in California, you manufacture in Taiwan, you assemble in China. Are they just writing off the cost of all that historical efficiency just to buy, like, geopolitical insurance?
That is precisely the calculation they're making. That hyper-optimized global supply chain was beautiful when the world was perfectly stable. But when you have threats of naval blockades, sudden tariff shifts, and energy spikes, that efficiency suddenly becomes a massive liability. Apple is looking at Broadcom and deciding that paying a huge premium for domestic manufacturing is ultimately cheaper than having 0 iPhones to sell, because a shipping lane in the South China Sea or the Strait of Hormuz got shut down.
Wow. So it's physical fortification. They are looking at the unpredictable macro weather and deciding to pour concrete and build a bunker at home. They're actively removing the global variables that they just can't control anymore.
And this represents a massive shift in how capital is deployed. The tech industry has realized that intellectual property isn't enough anymore. You have to own the physical means of production, or at least guarantee them within borders that you actually trust.
And this idea of tech giants securing physical footprints, it's accelerating way beyond traditional hardware like smartphone chips. They are aggressively expanding the physical infrastructure for next-generation technologies, specifically artificial intelligence and autonomous vehicles, and they are doing it across borders and, honestly, right into our local neighborhoods.
If we connect this to the bigger picture, we are watching the narrative shift from just securing present supply chains to aggressively colonizing the physical infrastructure of the future.
So look at Meta. The briefing shows that Meta's AI expansion is officially crossing the border. They are building their first big Canadian data center, and the explicit purpose of this massive new facility is to play a key role in their growing AI capabilities.
People often misunderstand the fundamental nature of artificial intelligence. We use terms like the cloud or generative AI, and it sounds ethereal, right? Like it's just code floating in the ether.
Totally.
But the reality is that the cloud and AI are incredibly heavy, resource-intensive physical industries.
But hold on, we treat software as infinitely scalable magic. You write an app once and 1 billion people can download it with almost zero marginal cost.
Yeah.
If Meta has to pour billions into Canadian concrete just to make their AI work, aren't they just becoming like a 19th century railroad company laying down track?
The railroad boom is actually the perfect historical parallel. To run these large language models, to train algorithms on billions of parameters, you need thousands of highly specialized, incredibly expensive servers running constantly. You cannot do that in a vacuum.
No.
That requires massive buildings. It requires enormous amounts of continuous electricity to power those chips, and equally enormous amounts of water or dedicated energy to cool them down so they don't literally melt.
So Meta crossing the border into Canada isn't just about, finding cheap real estate for a server rack.
Not at all. It is an infrastructure land grab. They are securing access to stable energy grids, favorable climates that naturally aid in server cooling, and political stability. The companies that own the physical tracks, the data centers, the power contracts, the water rights, they will control the AI era. You cannot dominate AI with software alone. You must dominate the physical resources required to actually run it.
Man, and this physical land grab isn't just happening in hidden data centers up north either. It's happening right on our local streets. The briefing notes that Waymo is expanding its driverless rides into 4 more major U.S. markets: San Diego, Las Vegas, Tampa, and Denver. This just widens their massive lead in the nascent U.S. robotaxi market.
And this is the physical manifestation of AI leaving the server farm and operating out in the messy real world.
Right. Waymo putting physical tires on the road in Tampa is a massive logistical undertaking. It is the absolute opposite of an invisible app on your phone. You need physical depots to clean the cars, charge the batteries, maintain the LiDAR sensors. You need detailed inch-by-inch physical mapping of these cities so the cars know where the potholes are.
The capital intensity required to scale a robotaxi business is mind-boggling. You're buying physical fleets of vehicles, leasing real estate in premium urban markets for maintenance hubs, and employing local workforces to service the robots.
So the underlying thing here is really undeniable. Whether it's Apple onshoring semiconductor manufacturing, Meta building power-hungry data centers in Canada, or Waymo deploying fleets of cars in Vegas and Denver, the tech sector is transforming to a heavy industry sector. They're spending billions of dollars on physical world assets to guarantee their digital dominance.
Which brings up a really fascinating friction point when we look at how the market values these heavy industry tech plays.
Exactly. We've seen Apple and Meta buy physical certainty on Earth. But how does this, buy physical infrastructure thesis hold up when the infrastructure is literally in orbit?
That's the billion-dollar
Or
problem.
$100 billion question. The ultimate physical frontier driving market action today is the space economy. And the briefing shows us 2 massive space titans having vastly different days, which perfectly illustrates the stark difference between private hype and public market reality.
The space economy is the ultimate test of capital-intensive infrastructure,
Yeah.
and the financial mechanics at play here today are incredibly revealing.
Let's lay out the facts for you real quick. First, we have Jeff Bezos' Blue Origin. They just hit a massive $130 billion valuation in their first outside fundraising round. The goal is to support their growing space exploration and tourism business. They are riding a massive wave of private success.
The $130 billion valuation for a private round is a staggering show of institutional confidence, just staggering.
But then you look at SpaceX. Today, SpaceX is listed as one of the market's top losers, right alongside traditional Earthbound companies like Rivian and DraftKings. The stock closed below its debut price of $148 in a 2-day slide, and this is following its inclusion in the NASDAQ 100.
Right.
And this slide comes despite the fact that SpaceX just had a record IPO that raised $85.7 billion. Demand was so high, the underwriters even triggered their green shoe option, that over-allotment to sell extra shares to the public. But despite all that hype, they are sliding. So what does this all mean?
This raises an important question, right? This divergence between Blue Origin and SpaceX is a masterclass in the mechanics of modern valuation. It exposes the brutal transition a company makes when it moves from private venture capital to the ruthless scrutiny of public equity markets.
Break that transition down for us. Why is the public market punishing SpaceX right now when the demand for their IPO was clearly through the roof?
Well, let's look at Blue Origin's situation in the private market first. When a private company raises an outside fundraising round, they're dealing with a small handful of massive institutional investors, sovereign wealth funds, or high-net-worth individuals.
Sure.
Those investors are buying a story. They are buying into Jeff Bezos' 30-year vision for human spaceflight. In the private market, you are valued on your maximum potential, on what you could become decades from now.
So you don't have retail investors scrutinizing your daily cash burn.
Exactly. You operate with a shield, you can spend billions on research, blow up a few test rockets, build massive infrastructure, and do it all without your stock price tanking on a Tuesday.
Right.
The private investors understand the long game.
But SpaceX crossed the threshold. They went public, they raised nearly $86 billion. They maxed out the green shoe option to dump even more shares onto eager buyers. And yet, 2 days later, they're trading below their debut price.
Because the moment you go public, the rules of gravity change.
Mm.
And getting included in a major index like the NASDAQ 100 acts as a massive accelerant to those rules.
Because index funds are forced to buy the stock.
Yes, index inclusion forces institutional buying, which drives initial volume. But it also means you are now permanently under the microscope of millions of algorithmic traders, retail investors, and quarterly analysts. You are no longer just a story about going to Mars. You are a math equation.
Wow.
Public markets demand transparency, steady cash flow, and predictable quarter-over-quarter growth.
So you have to show your homework every 90 days.
And when analysts look at the massive capital expenditures required to launch rockets, that physical infrastructure we keep talking about, they start applying traditional discounted cash flow models to a company that is trying to build a city on another planet.
Good luck with that.
Right. The public markets are incredibly impatient. They don't want to wait 30 years for a return on a space tourism vision. They want to know how you are going to beat earnings estimates next quarter while operating in a macro environment where the Fed doesn't even know what interest rates should be.
So SpaceX sliding below its $148 debut price isn't necessarily a sign that their underlying technology is failing at all. It's a sign that the public market is struggling to figure out how to value a company that burns billions of dollars on interplanetary infrastructure, especially when the cost of capital back on Earth is so uncertain.
It is the collision of sci-fi ambition with the cold, hard reality of Wall Street accounting. The public markets often punish high-growth, high-expenditure tech stocks much more harshly than private equity does, simply because public investors have a shorter time horizon and a significantly lower tolerance for mysterious cash burn. SpaceX is discovering that gravity on Wall Street is much, much stronger than gravity in private venture capital.
Which really brings this entire deep dive full circle. We started by looking at a global economy acting like a machine being ripped apart. And as we've unpacked these sources today, a picture of deep paradox has emerged for you.
Yeah, the market is fundamentally split between two eras.
On one hand, you have the market reacting to incredibly old-school 20th century fears. We are agonizing over whether the Fed will hike or cut rates by 0.25%, completely freezing capital in the process. We're watching oil prices jump 4% based on geopolitical threats of naval blockades, which instantly compresses margins for anyone who ships physical goods. Those are the heavy anchors holding us to the ground.
That is the traditional macroeconomic weather that every single business is forced to navigate right now.
But on the other hand, in that exact same turbulent environment, we are seeing billions upon billions of dollars being deployed into literal science fiction realities. Waymo is unleashing physical robotaxis in Vegas and Denver. Meta is pouring massive concrete data centers in Canada to power artificial intelligence. Apple is spending $30 billion to redesign the physical geography of semiconductor manufacturing. And we have private and public markets actively trying to put a price tag on colonizing space.
The companies that are succeeding right now, whether it's Levi Strauss using data to adapt to the consumer on the ground, or Apple building a $30 billion supply chain fortress, they are the ones recognizing that they cannot rely on the macro environment to be stable. They have to engineer their own stability through physical assets and strategic, decisive expansion.
Which leaves us with a fascinating final thought for you to ponder as you go about your day. We spent a lot of time talking about tech companies versus traditional companies, but as we look at the landscape today,
As tech giants like Meta and Apple lay down trillion-dollar physical infrastructures of concrete, steel, and silicon, and as traditional retail brands like Levi's leverage complex data algorithms to pivot on a dime and enter new global markets, this raises an important question. Are we entering an era where the boundary between a tech company and a traditional company completely ceases to exist? Will every company that survives simply be a heavy infrastructure data company in disguise?
the machine isn't just moving in two different directions anymore. The gears themselves are changing shape. remember, are two vehicles attached by a bungee cord, the 20th century anchor and the 22nd century spaceship. Well, it turns out you need a whole lot of heavy earthbound metal to build a spaceship, and you need a whole lot of advanced software to lift the anchor. Thank you so much for joining us on this deep dive. Keep questioning those headlines, look past the daily noise, and we'll be here next time to help you unpack whatever the market throws our way.